All right, Yield Nerds episode 182. This is an exciting episode for me for several reasons. As you can see, the other shoe is beginning to drop in equities, and that informs me a lot. And I also I feel like I'm doing something meaningful with Yield Super Bowl. I'll explain why in a second. Let's get going. We are at 490 something subscribers. Thank you for your support. If you're new, please remember to start from the roadmap playlist that organizes this show in the chronological order. There's a whole bunch of other playlists as well, and this one will certainly go into the Yield Super Bowl and the municipal bond playlist as well. Hey, before I go too far, I want to make sure I tell you to check my work. Do not believe what you see. Do your own homework. Well, four parts today. First, we'll kind of see how the market is doing. As you can tell, the other shoe is dropping all over the place. It's a scary time. We'll play Yield Super Bowl, see what that is saying, and see how the equity world is working out, especially with the other shoe in AI dropping. And I'll show you what kind of things I hold. My equity game is a high risk roulette, and I even spelt equity wrong there. Sorry about that. Schwab tells me that I am in the way out risk category, but I also absolutely demolish in the return. So, hey, I'm happy to take risks if I can get the reward, and it is a measured risk. Now, speaking of measurement, you may note that my equity allocation was a very, very tiny amount. It was a 0.5% of my entire portfolio a year ago. From there, it has slowly crawled up to now just north of 7% as of this episode. So here's kind of how mine is. Half of my allocation is in treasuries, most of that in the short term, and 7% in stocks, most of them US stocks. My muni bond allocation is creeping up. It went from 0 to now 21% in the last 6 months. Agency bonds at 10%. And lastly, investment grade corporate bonds. I haven't found anything exciting to buy there, but they are at about 5%. So where is the world in terms of the Yield Super Bowl? If you are new to this concept of Yield Super Bowl, please go find that playlist and watch it. It is my way of looking at the pre-tax yield, wherein I adjust it for tax breaks so I can compare apples to apples. And before I go far, I need to make sure I warn you that this is not investment advice, this is not tax advice, I'm not a wealth management advisor. I was there 3 years ago and had no clue about how the fixed income market worked. And I taught myself and I am sharing my education. So what is my bond strategy? I try and beat the treasury by a mile. And if I can beat the treasury by a mile, I'd buy it. So what does that mean? In the corporate bond stage, I only buy investment grade corporate bonds. If I need to buy a 10-year investment grade corporate bond, the 10-year treasury trades at 4.1 something percent. There's a little bit of steepening there. We'll talk about it. The treasury is state tax deductible, so the 4.1 is more like 4.3. So I look for corporate bonds that pay a coupon, not the yield to maturity, but they pay a coupon of 4.7%, and they are trading well below par, so the yield to maturity is more like 5.6%. This would put the price of the bond at around 95 cents on the dollar, and I still look for investment grade bonds. The reason I do that is I figured if I was the chairman of the board of a company and my company had a 10-year debt with a coupon of 4.7%, I would be so upset because the 10-year treasury is trading at 4.1%. And I would say, let's go call that bond. And that's what I want. I want these companies to pay me. I want to buy their bonds below par, and I want them to call the bonds so I can make extra yield. Well, what about muni bonds? Same deal, except the adjustment is higher. So if I want to buy a 10-year muni, I only buy investment grade. I look for a coupon, not yield to maturity, but a coupon of 4.25%. Realize that the 10-year treasury pays 4.1 something percent, that is state tax free. The 10-year muni that pays a coupon of 4.25% is federal tax free. So if I was on the board of that municipality, I would say, what the hell are we doing? Call that muni bond. And that is what I want again. And if you ask me to buy anything in the 20-year time frame, I'm going to say, well, you got to pay me 5% for all the same reasons. And if nothing matches, I'm okay. I'll be patient. I'll sit and wait. That is my bond strategy. It counts on munis and treasuries and agencies waking up and calling the bonds. Let me tell you how it worked out for me. If I buy munis at coupons above the corresponding treasuries, that means I get the tax break there plus a whole lot, and I refuse to buy them above par, so I have a built-in gain there. Then I sit to collect the coupons that exceed the federal tax rate, and they are federal tax free. Sorry, not the federal tax rate. They exceed the federal treasury that I can buy for the same duration, except the treasury is state tax free. I get that federal tax free. So I have these huge upsides already. And I sit there and wait for them to be called. When they are called, the difference between 99.5 in this example and 100 is a gain. So my yield is not only buying it below par at a really high coupon, my yield also has that extra kicker, which is that 50-cent gain if it gets called. And on top of all of that, if I bought a muni that has an OID or an original issue discount, as long as there is unaccrued OID, the difference between when I bought it and the par value is also tax-free. So there are layers and layers of gains and tax-free gains built in. And if I can't get this, I patiently wait. So let's see how that worked out. If these bonds are getting called, then I know I'm doing the right thing. Here you go, FFCB. Here you go, another call. Here is a third call. Here is a fourth call. Here is a muni call. I have three more getting called, and it is raining calls in my portfolio, and that is how I know my strategy is working. Now, what happened to the treasury curve? This is the yield curve. And what you're seeing here with the little dots is where the yield curve was in September. The orange is the September. Yellow is the October. So the yield curve fell, and dramatically in the last 2 months, the yield curve has gone up on the long end. And here is the crazy part. The short end is correspondingly falling. The short end is falling because the Fed is trying to decrease short-term interest rates, and the market is accepting the lower short-term interest rates, but they are worried about long-term risks, and so the long-term rates are going up. When that happens, the fancy word is bear steepening. You got to be careful about increasing duration. The market is saying, I don't know if I'm going to get paid, so I'm going to ask for a higher yield. That's what the market is saying. And so you have to be very thoughtful about when to buy, what to buy. And here is what this tells me. The long end is rising, the short end is falling. Therefore, you could sit here and say, do not increase duration. The way I think about it, if you meet my filters, meaning if you pay well above the 10-year and you give it to me tax-free and you give it to me below par and you give it to me below accumulated OID, I'll take a lot of tax-free money. I can be convinced. But then I also want to play the yield Super Bowl. And if there is a yield Super Bowl winner that qualifies, I'll buy it. Otherwise, I'm going to go to equities for my gains. Well, this is my analysis of just my fixed income portfolio, and it compares it with the Bloomberg US credit market, which is all the bonds. When I saw this, I was shocked. And I said, wait a second, all of this stuff I am doing must be wrong because the average credit market is absolutely destroying my performance. I need to close this channel and just go buy the ETF that represents the average aggregate market. And so I went out and found that ETF. Oh, not exactly a fun story, people. The reason I am losing out in the last month is because it is going from disaster to slightly better disaster. This is the bond ETF called BND. It is all US bonds that are investment grade. However, it pays about 3.8% in coupon. Most of it is taxable. Most of it is taxable. So to get 4% taxable and then pay state income tax and federal income tax, No, thank you. I'm not going to own that. Just because the last 2 months that performance beat my performance, it really doesn't include taxation, and that is the crux of Yield Nerd. So I am good where I am. So let me move to Yield Superbowl. And you may remember when we played this in August, agencies were in the middle dominating, treasuries were paying, look at that, 4.5%, and munis were north of 6% on the long end. And we were worried that, ooh, the short end is going to fall and we're going to have a disinversion. Let's see if that came true. Are you ready? Here you go. Here is 12 2025, and it is a shocker. Munis have taken over the curve, and treasuries are now south of 4%, 3.5% in the short term. And here is what this means. If you were thoughtful enough to buy munis at the right time frame, you would have gained a lot on your muni portfolio. A lot of it would have been called. When those get called, you get to book the gains. And so the question is, now that munis are the only place to put money, and even those don't pay above 5%, which is what I want for long term, and some of them may not pay more than 4.25% for 10 year, what do? I started looking on the equity side. Here is me versus NASDAQ. When we had the crash of gold, I lost a lot of the advantage I had built in. This is me leading the market by 2x. And when gold crashed, I trailed the market and I am slowly coming back, closing that gap and beating NASDAQ. So how do I do that? Some of you may remember I developed my own algorithm and I kept tweaking it and tweaking it and tweaking it, and it is clearly working for me. You should do you. Some of you asked if I would share the algorithm, and this is the special surprise. The last month, I have tweaked my algorithm enough that I know that it is beating the NASDAQ. That doesn't mean it will continue to do it. That doesn't mean you should use the algorithm. But for the first time, I am sharing my algorithm with you. I am not going to put this link on the description. If you really want to use it, it is yours to try. I'm going to just offer it just so I can learn how you use it. But you would go to https://yield.orange-letter.com/evaluation. The link again, yield.orange-letter.com/evaluation. It's going to ask you for a username and password. The username is evaluation. The password is lowercase test -11-17. When you do that, it is going to show you a screen that looks like this. Mine says private because I have a different copy where I tweak a lot more. Yours will say guest or test or evaluation or something like that. The first thing you are going to do is click process MACD signals. And I'll tell you what that is later. And once you do that, it is going to think it'll turn gray and it'll come back and say, I did it. I processed 228 symbols or whatever it may be. Then you can click view the sheet. And you're going to see the sheet that has 3 worksheets. One is parameters. My suggestion to you is to not mess with parameters. The second is symbols. Symbols is where you would enter the stocks that you are curious about. I have populated my copy with every stock in the NASDAQ, with every stock that meets my equity criteria, and that is where you would have symbols, and the output is going to tier these based on the algorithm. Tier 1 is stocks that are going on a straight line up, up, up with momentum for 6 of the last 6 days. Tier 2 is doing it for 4 days, and it may not be doing it on the other 2 days. Tier 3 is 2 out of the last 2 days, but the others may or may not be the right one. They may be a MACD crossover. So Tier 3 may be the beginning of a run, but I don't know. Tier 2 is a short run, and top tier is a big run. And here is how the symbols worksheet looks. You would just add 1 ticker for each line. And here is how the output looks. So for today, for example, Tier 1 had DG, Dollar General. If you look at Dollar General, you will see that it was going up, up, up for 6 trading days. Keurig Dr. Pepper, 1 OK, TD Ameritrade, the metal company, uranium company. And so these are stocks that are going straight up, and nothing met the criteria for tier two or tier three. If you run it when the market is not open, you're not going to get quality data. So you'd have to run it when the market is open. And so that is what I've been using to trade for the last month. And as you may remember, I'm cleanly beating NASDAQ for the last month. And here are my holdings. I do have some duds, so it's not like everything I do works. But I've had some really solid luck. Every day that there is a recommendation on tier one, I make a bigger allocation. When there is a recommendation on tier two, I make a medium size allocation. And tier three, I make a small size allocation. And so I just keep doing that every day. And you can see I have Lumentum, Protagonist, Enersys, Google, Amcor, Board Drilling, and so on. And that is the first page. And then I go on to the second. I got Merck, Credo, Mueller, Caterpillar, and TD Ameritrade. You just saw that. I'm up 6% on that. So you can see that I just eat the dog food. I buy what the algorithm tells me to. And over a period of time, I have at least off late beaten the NASDAQ, and we'll see where it goes. So this is what has worked for me. You do you. Please share your comments. And if you use the algorithm and you learned something, I would love to learn from you. If you have feedback on what I can do better, please share them in the comments. Thank you and have a nice day.